2017 Pennsylvania Tax Update was a live webinar that was originally produced on Thursday, July 27, 2017. The presenter for this presentation was Michael Eby with McConley and Asbury. Enjoy this webinar recap and visit us online at www.macpas.com for more information about our future events.
Thank you, Tyler. Just want to take a moment to welcome everybody to the Pennsylvania Tax Update today. You know, when we scheduled these many months in advance, you pick the date that makes the most sense, and late July typically has made most sense for a Pennsylvania Tax Update because we have an enacted budget by then. Well, it turns out we don't. We have a partially enacted budget. But actually, I think it's going to work out for the better here and kind of make it a little more interesting because things are still moving in this process. In fact, I even had to update some of my slides just this morning for some updates that occurred in the Senate last night. So stay tuned to that. We're going to talk about the budget first and then get into some other legislative updates. So just a brief introduction about myself. I lead our state and local tax practice here at McConley and Asbury. Actually been a part of the state and local tax practice here for about 9 years since its inception. We focus on a few areas for our clients, identifying savings tax or tax savings opportunities, most commonly through sales and use tax reviews. We help our clients ensure that they're maintaining compliance with state and local tax laws. We also help them with their systems and reporting and processing procedures for sales and use tax. And we also represent clients before audits and appeal levels, both reassessment and refund appeals. So taking a look at our agenda today, the first item is going to be the overall overview of the state budget, what taxes were at play and are still at play because we don't have a revenue piece yet for the budget, and what was the governor's proposal along with what did the Assembly propose most recently, or General Assembly. We'll also review some recent decisions from both the Commonwealth Court and state Supreme Court levels, as well as take a look at some highlights on some PA tax legislation. There's a lot of outstanding bills there, especially in the House right now. Third item is the PA Department of Revenue year in review. I have probably two words to describe that at this point. It's definitely aggressive and I think overreaching is maybe the other word that could describe that. We'll get into a little more detail on what that is in a little bit. And then how does PA's tax structure compare to other states? This is kind of where we take a look at some of the other budget deficits across the nation. How are states handling that, and what tax laws are they enacting or reform are they making take place? Some of those items are trickling their way to Pennsylvania, and it kind of gives us a highlight or a preview, I should say, of what we might expect in Pennsylvania over the next couple of years as we talk about budget negotiations and overall having a structural deficit over the next couple of years. So let's talk first about the enacted state operating budget. I would say let's call this the spending portion of the budget. Again, we have about $2.2 billion shortfall in revenue. So a lot of the revenue is spoken for, but there's quite a big gap to remain to make this a balanced budget. Obviously, it's required that states have a balanced budget each year. So if you look at fiscal year 2016-17, it was a $79 billion total budget. You only usually hear about the general fund budget that gets the much of the attention, and most of the negotiation goes on there. Really, the federal funds and the other funds. Federal funds are really spoken for each year. They're used to cover Medicaid costs, roads, and education. And then other funds are the motor license fund, lottery fund, the tobacco settlement fund, and the property tax relief fund. Really not much to say on those. So we tend to focus then on the general fund. If you notice, the federal funds and the other funds did get relatively small increases, and the general fund was actually relatively small as well at $32 billion. If you can recall back to February when the governor released his budget proposal, he called for a $32.3 billion budget. So you can see the enacted budget actually is pretty close to that. I would say by far the budget that the governor proposed back in February was his most conservative of his first three here. In fact, some people even were calling it a Republican form budget. There were things like certain tax cuts and consolidations of government entities that have really were able to cut funds for that. Now, the enacted budget, the operating portion, passed into law back on July 10th, and this is the third year in a row that it passed without the governor's signature. I would say this is actually probably would have been the easiest negotiation for the budget for Wolf's first three budgets, primarily because it was such a conservative spending budget. However, we were looking at, as I said, pretty large deficits. 1.5 billion of revenue was under-collected, essentially, compared to estimates for this past fiscal year. And then going into this current fiscal year, the one that we are currently in now, there's a structural deficit of 700 million, leading to about 2.2 billion. So the shortfall, just to kind of give a couple numbers for why we are short for fiscal year 17, the previous fiscal year. Sales and use tax was down almost $200 million compared to estimates. That's 2%. Personal income tax was down $387 million compared to estimates, about 3%. And then corporate income tax was down $340 million, about 6% less than what was estimated in last budget. Now, I don't really typically go over the spending provisions in the budget. I tend to focus on the revenue side, which has the various tax reforms in it and tax law updates. But since this is the only enacted portion of the budget, I just wanted to briefly highlight a few things. It's in total $870 million general fund increase in actual spend compared to fiscal year 17. $430 million of that is an increase in state education funding, which includes a few components there, just highlighting $100 million for basic education, $25 million for pre-K accounts program, $25 million for special education, $9 million for the state system of higher education, all increases there. And then the state-related universities, which is Penn State, Pitt, Temple, and Lincoln, they all remain flat on their funding. Also, a 6% increase in pension cost and a 19% increase to opioid and heroin treatment. Obviously, an epidemic across the nation, and Pennsylvania has not been spared in that regard. So, significant increase there in the treatment for that. So let's take a look here at some of the tax measures that the governor proposed back in his budget in February. I think the best way to start is to take a look at what was not in his proposal this year. There was no personal income tax increase, and that was different from his first two proposals in that he tried to increase the personal income taxes both years, fiscal year 16 and fiscal year 17. It's, I would say, very low-hanging fruit in terms of raising revenue. Every 0.1% increase to the rate for personal income tax is anticipated to raise $410 million of revenue. So you can see a couple tenths of a percent or 0.3% increase could really close the budget gap quickly. The issue is that it's usually politically not favorable because it's seen as really raising a tax rate or a tax increase on everyone in Pennsylvania. Which obviously you can see is not popular. Sales and use tax is the same thing, and he did not propose an increase to the rate for that either. And he didn't last year either, but his first term he did propose a rate increase. And again, this is seen as a sales or a rate increase, a tax increase on everyone in Pennsylvania. So also not, I would say, similar to last year, if we look at the sales and use tax base expansion, it wasn't broad sweeping like it was 2 years ago when 45 exclusions or exemptions were at risk of being written off the books. There was some minor expansion last year. It was to digital products, which included services to canned software as well. And that actually made the enacted budget. For this year, custom computer programming is probably the biggest piece. For sales tax purposes, there's two different types of software. There's canned software, which is readily available to the public and available to be used by really any type of customer. That's, think of just Microsoft products. And then there's custom software, which is uniquely for one particular client or taxpayer. The taxability of which canned software is taxable and any services related to that are taxable. Custom software and any programming related to that is tax exempt. Sounds pretty cut and dry, but it's actually one of the grayest areas in tax, sales tax in Pennsylvania and in a number of states, just determining what the taxability is of that and what is actually considered custom versus canned. The only positive to removing and making this exclusion all of a sudden taxable would be that there would be no gray area. All computer services would be taxable, which is rare. Most states don't tax all computer services, so this has met the tech sector in Pennsylvania has really lobbied against this piece. A few other things: data processing, storage services for businesses, and aircraft sales and aircraft repair parts. If that sounds familiar, it probably is, because that exemption was written into law just several years ago. So what the Commonwealth giveth, it taketh away in sometimes. And then also airline meals was also one of the expansions proposed. Natural gas severance tax is 6.5%. A severance tax was proposed in both of his earlier budgets. And I do have an update. The Senate just voted a couple hours ago to approve their version of the revenue part of the budget. And they do have a severance tax in there, although it's 2 cents on every 1,000 cubic feet extracted. So it's less than what the governor's proposing, but there is, for the first time, it looks like there could possibly be an enacted severance tax in Pennsylvania. Another line item is a $100 million cut in state-funded credits. There's no details yet or analysis out there which credits will actually be cut. If this goes into law, what will be done, and most likely through the DCED and some outside groups, they'll look at what credits have the biggest bang for their buck, and the ones that don't have much upside will either be cut or significantly reduced. I get a lot of questions on the EITC program. That one does not appear to be in jeopardy. In fact, there might actually be an expansion or a spending increase on that. That's a very popular program among both sides of the aisle and for taxpayers and nonprofits. So that one it does not look like it's going away or being reduced at this point. And then one of the last major items was the expansion of insurance premium tax to some currently exempt entities. These would be mutual beneficial insurance companies, which are currently exempt in Pennsylvania from this tax. So just think of kind of the credit unions of insurance. Way to describe that. On the next slide here, just continuing the discussion of the governor's tax proposals, corporate tax reform was one of the largest items that he addressed in his budget proposal in February. The first item there, mandatory combined reporting. This would be pulling in businesses that have a unitary function together or related parties, and make them file one report in Pennsylvania. Right now, Pennsylvania is considered a separate filing state for corporations and their subsidiaries. So the intention here is to broaden the tax base by bringing in taxpayers into Pennsylvania that currently aren't filing, by requiring them to file with Pennsylvania parents or Pennsylvania subs. It also would close what's known as the so-called Delaware loophole, which businesses use to pay royalties to related party intangible holding companies situated in Delaware. There is some downside to combined reporting, the fact that it does water down the apportionment of income to Pennsylvania if you're pulling in companies that have a lot of activity outside the state. It also potentially pulls in related party companies that have losses, which would net against income from companies that are already filing in Pennsylvania. So there are winners and losers when you do combined reporting. And a lot of states have done studies. Many states do have combined reporting. A lot of them are out west. But some states that have recently added it or considered it have done studies prior to going to combined reporting. Maryland did about 7 or 8 years ago. And they found that through their study that combined reporting was not going to raise enough revenue for Maryland to make it worth it. So they actually scratched that idea and remained a separate filing state. So if you're going to broaden the base, you also have to do something to kind of make Pennsylvania still somewhat friendly to the business community. So a gradual reduction was also proposed in his plan for the corporate net income tax, about 3.5% total by 2022. Third item there is capping the net operating losses for all C corporations to 30% of income. This was definitely a reaction to the taxpayer-friendly case of Nextel at the end of 2015. We'll talk a little bit about that in a few minutes here, but pretty much right now there's a NOL can be taken in Pennsylvania at the greater of $5 million or 30% of taxable income. Most taxpayers can fall under that dollar maximum, so they get to take NOL to completely wipe away their taxable income for a current year. Some larger entities cannot, and they're restricted to the maximum of 30% of their taxable income. The Nextel case ruled that the dollar maximum was unconstitutional because it violated the Pennsylvania Uniformity Clause and was granted a refund in that case. The state obviously does not want to be looking at large refunds going forward for large corporations that have significant NOL, so they're looking for a law change here to make it a straight 30% of taxable income during the current year. And then bringing back the capital stock tax, that's actually just a joke. I put that on there because it's probably not really that funny, but in the sales use and use tax, the state and local tax committee, they find this funny because for well over a decade, this tax was supposed to come off the books, and it just kept staying on there. It gradually got lower. Finally, in 2015, it went away. So, kidding now, but there is potential if we're talking corporate net income tax rates decrease and also still facing deficits. The Commonwealth is going to have to look for ways to raise revenue, and they might bring this right back into play. It had been on the books for a number of years, and if it's not capital stock tax, maybe a minimum filing tax like a lot of states have. You look at some of our neighbors. Maryland has a $300 minimum tax. New Jersey has a $500 to $2,000 minimum tax. So I am kidding about cap stock right now, but that certainly could be on the negotiation page at some point. So what has the General Assembly proposed for funding measures? Well, gambling expansion is one of them, and if that sounds familiar, it is. That actually was in the enacted budget last year for online gaming specifically. They had written up about $100,000 of revenue to balance the budget for taxation of online gambling, with the idea of passing legislation later on to actually make it legal and to regulate it. That didn't end up happening, so that actually is part of the budget deficit going into this year. So they would be enacting that and also bringing in slot machines into airports and bars, kind of an extension of the casino-style type of gambling. And that is actually included in the Senate, most recent Senate proposal that was approved just a few hours ago. And they're calling for about $200 million of new revenue for that. Taking a loan against the Tobacco Settlement Fund, both the House and Senate have proposed this, and this just the proposal from last night, and from the Senate, they would be borrowing $1.3 billion from this fund to help balance the budget. Restructuring the sales tax for alcohol sales, I don't believe that made the Senate version. That was on a previous version from the House. Taxation of space on energy transmission lines. And then these last three items are in the Senate version here that just, again, passed. Gross receipts tax increase on utilities. This is going to probably be a little unpopular, and you're going to hear about this probably some today and tomorrow as more news of this gets out. On all electric bills, there would be a 0.6% increase to the gross receipts tax. There would also be new gross receipts tax, or actually bringing it back, it's been gone since 2000, on gas bills of 5.7%. And then telecommunications bills would have a 1% increase in their gross receipts tax. So obviously anyone that has a house or pays utilities on their rentals, it's going to affect everyone. As I mentioned before, the natural gas severance tax, they're expected to raise at least $100 million from that. And I do have a number on the gross receipts tax. That's actually expected to raise $405 million for the Commonwealth. And then one that's not expected to raise much revenue in total, about $3 million, but I thought it was interesting, a 12% tax, calling it a sales tax, it's just a general tax on consumer fireworks. So that's obviously probably there to cover the increased costs of burden for covering medical expenses related to firework injuries. So I like to look back sometimes on our past budget webinars just to see what we had discussed and see how it kind of turned out the year later. So if I look, we had this slide back in our webinar presentation back in 2016. We recommended or said we should be on the lookout here for 5 categories that weren't in that current budget for the fiscal year, but are definitely going to be on the table in future years. Maybe not quite the next year, but years after that. So I'm at least proud to say that at least the top 2 are not on there. Personal income tax rate increase and the sales and use tax rate increases weren't on his budget proposal for this year, but it's very likely they'll be on there at some point either next year or the year after. And I talked about the personal income tax rate increase being kind of low-hanging fruit. It's a 3.07% tax rate right now, which is really low if you look at it compared to the national average and the states surrounding us. But there is some smoke and mirrors effect to that because you have also a local income tax rate that's filed on a separate return in Pennsylvania. So you got to combine those 2 rates. A lot of state returns will have the local rate enacted right into the actual state return. There's also not as many deductions for personal income tax for Pennsylvania. A lot of states will follow federal and allow for itemized deductions. You're also unable to really utilize net losses. If you have a loss from a sale of an asset, you're not going to, if it's greater than your income from sales of assets, you're not going to be able to use that loss against other classes of income, such as dividends or wage compensation. Likewise, you're unable to take losses from one spouse and net them against income from another spouse, unlike a lot of states that do have a true joint return. So the effective rate in Pennsylvania is actually probably a little higher than the rate itself, and it kind of leads you to believe. So even though it kind of might be considered low-hanging fruit, it really isn't. Sales and use tax rate increase also wasn't on the table this year, unlike it was 2 years ago. We also talked about wide-sweeping sales and use tax base expansion. We haven't had wide-sweeping like we did back in 2015, where 45 services or items were considered to be up for negotiation to be taxable. But we have had a few things proposed over the last 2 years, and last year with the digital products being taxable, that being enacted, plus a few of the items that are proposed this year. We're slowly chipping away at that. So there has been a base expansion, and wide-sweeping base expansion might occur in proposals again in a couple years. I already talked about corporate tax reform. That certainly did take place in the budget proposal. And then natural gas severance tax has been proposed, plus has also been voted on and agreed upon in the Senate. Now, a lot of what I talked about on the last slide with what has been voted on by the Senate, there's been no talks that in the House at this point that's likely to pass there. So it is going to be a long road to get some of these revenue spending or revenue measures in front of the governor for signature. So I would say all 5 of these areas, keep them on the lookout again for as we go into future years. I'd also add one other area, and that's the Department of Revenue's increased scrutiny and assessment procedures and initiatives that they're taking. There's definitely expected to raise a significant amount of revenue for that, and it doesn't look like it's going to be slowing down anytime soon. So I thought this slide's always interesting. If we take a look at the state's official budget website, I got a lot of this information off there showing what revenues are made up of the general fund budget. You look at personal income tax there and sales and use tax, that makes up over 70% of the general fund budget, which it's definitely not atypical from a lot of states what they have. Those tend to be the 2 biggest revenue makers in most states, except for states that don't have one of those types of 2 taxes. One other interesting note is cigarette tax has definitely increased as a percentage this year. There were increased the cigarette tax by $1 a pack last year, and some also tobacco-related products were also increased in last year's budget. So that explains the increase there. This slide kind of dictates what economists look at when they're budgeting for state shortfalls in future years. You look at your 3 major income producers there for most states and Pennsylvania, as well: individual income tax, sales tax, and corporate income tax. And what this chart represents is the percentage of change from year over year of collections. And you can see there, corporate income tax is all over the board there, and that's because corporate income tax follows closely with how the economy is doing. So in recession times, corporate income tax, you can't rely on that. It's good when the economy is doing well, but it doesn't do well when the economy is doing bad, or poorly, I should say. Pennsylvania only gets 9.2% of their general fund budget from corporate income tax, but that's actually a relatively high percentage compared to most states. I'll say this several times today, that corporate income tax rate in Pennsylvania is one of the highest in the nation. It's actually the highest flat tax rate at 9.99%. So Pennsylvania is a little susceptible to economic downturn because of the amount that they rely on corporate income tax. Personal income tax is a little more reliable, as you can see, but still has some dependency on the economy. Sales and use tax is actually the most consistent, and that tells the answer in most of the states as well, not just Pennsylvania. Although consumer spending does decrease during a recession, it's much slower decrease, and it's not as dramatic as the effect on income taxes. So if you're looking to close a budget shortfall or deficit that you're looking at for many years down the road, sales tax is usually through expansion of the base or a minor rate increase is a good way to consistently count on revenue. So that's the budget as it stands at the moment. We're going to stay in the mode of reviewing Pennsylvania tax updates by taking a look at some of the legislation that's out there, as well as some cases that were handed down from the Commonwealth Court and State Supreme Court over the past year and a half. We'll then also close the section by taking a look at some Department of Revenue updates, some of their policy and position updates and procedures that have changed over the past several months. So starting with legislative updates here, I know we have a lot of CPAs on this webinar. As much as I'd like to think they're here to just enjoy the wonderful content of what's being presented here, I know we all need CPE, so we are offering 1 hour of CPE here. So this first bullet point here is probably of concern to a number of our listeners. I think we've heard a lot about the first 2 points here, the 400-hour test requirement, or some of the older CPAs on the call might remember 800-hour test requirement to just get our CPA license, the 1 and 2 year requirement. It was hard for tax specialists to get this because they would have to go out on audits or do audit and accounting work to get that. Also for people that were working in or CPA applicants that were working in private industry, not in public accounting, they needed a CPA to directly supervise their hours. This law change is now going to actually require only CPA verification of their hours, and it's going to eliminate the 400-hour test requirement. So both very big positives for non-attest CPAs there. And then for continuing CPAs, every 2 years we have to renew our license, and we have to show that we had 80 hours of CPE credits. 16 of those hours have to be in audit and accounting. Again, for a tax individual, this is a little overkill because we don't need that many audit and accounting hours. So for non-attest CPAs, ones that aren't doing reviews and audits, that requirement is eliminated. Now, I want to point out very clearly that that's effective January 1st, 2018. So that's next reporting period. The hope was to actually get that in this current reporting period of 2016, 2017. And you can see Act 15 there. It's been around since 2013. It's moved very slowly. So make sure you get your 16 hours of A&A CPE in this year. But the nice thing is we don't have to worry about that as non-attest CPAs going forward. Second one there, House Bill 1537 and then Senate Bill 515, expansion of the NOL deduction. Again, this is a direct reaction to the Nextel case, as we talked about before. This would change, if you're going to take away the dollar maximum benefit, the counter to that would be to increase the percentage from 30% to 44%, so that's not such a hit on smaller and medium-sized taxpayers. House Bill 542 is an online sales tax notice bill, and when we get to the section on national developments across the nation for other states. This is one that's been going on in several states already and is finally making it to Pennsylvania. If an online retailer does not have nexus for sales tax purposes, they don't have to collect sales tax. But how does the state get their money? Well, they're going to go after the purchasers. The way to do that is to have the online providers actually send notices to those purchasers to notify them of their use tax requirement. And the proposal there for House Bill 5482, any purchaser in Pennsylvania that receives more than has purchased more than $500 from an online retailer, that online retailer would be required to send a notice at the end of the year to that customer. House Bill 1584, this would be a reduction in the corporate net income tax rate from 9.99% to 5.99%. So this would not only bring Pennsylvania more in line with its neighbors on the corporate tax rate, but also it would actually be lower than a number of them. I don't see this going through at this point, just with the budget deficits that are currently in place. But if some variation of this does go through, maybe at a lower decrease potentially. Continuing legislative activity on the next slide here. House Bill 866. This is for local income tax updates. A lot of the language in this bill was in House Bill 245 that in the last session of the calendar year in 2016 actually was approved by both sides of the General Assembly and then vetoed by Governor Wolf. The Assembly had already left for the year, so they could not override his veto. So they have to start from scratch. So that's what House Bill 866 is. What this is, it's some clarifications and updates on Act 32 of 2008. And if you recall what that was, the Local Enabling Tax Act. Streamlined local income tax collection among all the different localities and cut down the number of tax collectors at that time from over 600 down to 69. There were some stones that were turned over with that legislation, so this is offering some clarity on those things. The first one would be a full credit for residents of a home jurisdiction where the resident goes in and is actually employed at a work location in a distressed locality that has a higher rate. The residency location or residency of that taxpayer would only get a credit for 1% of the tax paid to that distressed locality, whereas the distressed locality actually can go higher, up to 1.25 or 1.5%. So there is some double taxation there if you're only getting a credit then of 1% then at your home location. So that would allow for a full credit there. They would also eliminate the requirement that a local income tax return has to be filed by everyone. So retired individuals or homemakers, after filing one final return, would no longer have to keep filing returns unless they had earned income. The third item would be that the Department of Community Economic Development, the DCED for short, would be the oversight board for the state for Act 32, because currently there really is no oversight of all the localities. There'd be a full credit for out-of-state taxes paid, and also safe harbor rules similar to federal for making estimates, which would allow you to make estimates of 100% of prior year to avoid underpayment of estimate penalties. The last three House bills there all are personal income tax related, which would cover both S corps and partnerships because they follow personal income tax rules. House Bill 331 would bring into federal conformity like-kind exchanges, 1031s. A good example of this is if a investor is selling a real estate property at a gain, they're able to defer that gain for federal purposes and just reduce their basis in their new building that they purchase, as long as they purchase it within a certain amount of time. This allows for better cash flow purposes, and instead of paying the tax on the gain, they're able to use that cash flow to purchase a new property. PA does not follow like-kind exchanges at this point, but this would bring that into conformity. House Bill 332, we talked about how losses are use it or lose it. You can't carry those over. So this would allow carryover losses similar to what federal allows for. And then House Bill 333 brings into conformity with the Section 179 limits, which allow you to expense assets placed in the service in the current year for federal purposes up to $510,000 currently. In Pennsylvania, it's only $25,000. Major difference there. So this would bring it into conformity with federal limits. C corps already are in conformity with federal limits, so the personal income tax is actually the oddball out here. All right, so let's move into some case law here. Some very monumental cases came down at the very end of calendar year 15 and are still in play because they're actually being heard right now at the state Supreme Court. But Commonwealth Court ruled in Nextel that they should receive a refund because it violated the uniformity clause that we talked about before with net operating losses, and the fact that as a large taxpayer, Nextel still had to pay income and this would have been, I believe, the 2007 tax year, even though they had NOL. More than enough NOL to cover their taxable income, but they were reduced. They could only take a certain rate at that time, I believe was 20%. Whereas taxpayers that are smaller are able to usually wipe out their entire taxable income because they had that dollar maximum that they could go up to, which currently is $5 million. At that time, it was lower. Commonwealth Court agreed it did violate the uniformity clause and made a decision that Nextel should receive $4 million for that tax year for tax relief. The Commonwealth, appealed that to state Supreme Court, and oral arguments were actually heard earlier this spring. And it does really look like the taxpayer is going to maintain a favorable decision on this, and the Commonwealth Court decision is going to be upheld. So that definitely leaves Pennsylvania with the decision on how to handle this going forward. R.B. Alden was another case, similar fact pattern, just different year. Also monumental was the statute of limitations for refunds. The mission funding case that was handed down in December of 2015, that allowed for taxpayers to use to extend their statute of limits for getting a refund, to be able to use the extended due date of the return, not the original due date. Department of Revenue had always taken the position that the original due date of corporate income return was the due date to start the statute of limits, but mission funding successfully argued that it should be the extended date because you don't know what the liability is until you actually file the return. At extension time, it's just an estimate of what the tax liability is, so it can't be a known liability. Last one was realty transfer tax, which was earlier this year, a decision. It was favorable for the taxpayer in this case, Saturday Family LP. The way this worked is that realty transfer tax must be assessed on leased real estate in Pennsylvania if the real estate term or the lease term exceeds 30 years, and that would include options as well for extension. So this lease in this case was 29 years and 11 months, and then had several 5-year optional extensions at fair market value. So the way the law reads is that if the lease extensions are fixed rental options and there's no room for negotiation, then those extension periods count to the 30 years. In this case, it was going to be based on fair market value, which is not a fixed value readily known at the time of the signing the lease. So it did not count to the 30-year rule, and transfer tax was not due then in this case. So Department of Revenue updates, like I said, very active and very aggressive this year. They released 2 letter rulings on the same issue. One was redacted right after it was released, but it was related to services related to CAN software. And this was some language that they had snuck into the legislation of Act 84 that passed with the budgets last year and became effective in August, saying that any support services to CAN software were taxable, even though traditionally computer services were non-taxable in Pennsylvania since 1997. But they took it quite a step further in their letter ruling that they released in February, saying that any computer training, would also be taxable, as well as general consulting if it had anything to do with CAN software. They got a lot of pushback on that, and I don't think I've ever seen this happen right after a letter ruling is released, but they redacted, pulled it off the website, and said an update's coming soon. Then in April, they released one that was much more confined. They said support services, yes, to CAN software, like IT support, help desk support of CAN software is taxable, but training and general computer consulting services would not be taxable. So falling within more of the confines of Act 84. Of anything on this list, the second item there, Board of Appeals large appeal procedural change, is the most concerning to me. Board of Appeals came up with, which is run by the Department of Revenue, it's the first level of appeals for state taxes, income taxes, sales taxes, a number of other taxes the Department of Revenue administers. They said for sales tax appeals that are larger than $100,000 in terms of the refund request, or are otherwise voluminous, maybe with the number of invoices or transactions being presented, Board of Appeals at their discretion then can completely dismiss that appeal and send it right to the Department of Revenue's field office for an audit. So a field auditor would actually come on site and essentially try to whittle down the refund request by finding liabilities in that same period to counter it. As you might expect, this would probably hinder a lot of taxpayers from going after refund appeals, and I'm talking smaller to medium-sized taxpayers, because a lot of the larger taxpayers are already on a regular audit rotation, and a fear of having a field audit or generating a field audit is not a concern to them. But this is really just going to hurt the medium taxpayers. The Board of Appeals is dramatically understaffed or significantly understaffed, and this is one way that they think they can cut down on the amount of work that they have to process by essentially discouraging taxpayers to come forward. So very disconcerting, I think, in our community that this came about. And I wouldn't be surprised if there's going to be some lawsuits regarding this. There's also been assessment and appeal reforms for the Department of Revenue that they're proposing to become law. This would shorten the appeal assessment period for a notice from 90 days currently to 30 days. That's a significant decrease in the amount of time, turnaround time. If you've ever gotten an assessment notice, they have a date on them, but then they have to go through processing at Department of Revenue, then mailed out. Sometimes you get them a week after the actual letter date, and then you only have a little bit of time then, if it were 30 days, to actually file for a reassessment. So this is heavily being contested by the PICPA, and one other proposal that was originally in the assessment appeals reform was that all legal arguments must be made at the first level of appeals. This would essentially bar CPAs from being able to refund or reassessment petitions for their clients, even for minor issues, and a lot of taxpayers from representing themselves at the lower levels, because if there was an issue that had to go up a higher level where they would need to have an attorney, that attorney would not be able to raise that issue because it had to be raised at the lower level. Thankfully, that's been dropped from the most recent language in the reform here in June. Sales and use tax desk audits. This is being run by the pass-through division of the Department of Revenue, the division that oversees S corporation and partnership income returns. They're using analytics here. They're sending out lots of assessment notices or general inquiries to taxpayers where they're seeing a certain dollar amount of gross sales on their income return and wondering why there's not enough sales tax being remitted. Usually the case is because they're either selling some taxable items and some non-taxable items. But it puts the onus on the taxpayer then to somehow prove that they did not have as much taxable sales as the Department of Revenue is suggesting they do. The Department of Revenue is also going after non-registrants, ones that file corporate returns or Schedule Cs but don't file sales and use tax. They're also going after entities that have maybe a few missing periods of sales tax reports. The next one, Schedule C taxpayers. I've seen a few notices for our taxpayers come through this, and I know a lot of other practitioners are getting them for their clients. These have been sent out in the thousands, similar to what the Schedule UE program was a few years ago, where a lot of notices were going out for unreimbursed employee expenses. It's requiring the taxpayer to substantiate certain expenses on their Schedule C. Door-to-door visits from the Department of Revenue collection agents. This is occurring, and it's confirmed by the Department of Revenue that they are doing this. If they're essentially following up on collection issues or the taxpayers that are not responding to notices. If the taxpayer is not home or at their business when the Department of Revenue agent shows up, they will provide a card and ask them to give them a call. One of the real positive initiatives by the Department of Revenue was the practitioner access of client tax account statements through e-tides. This is something that I use quite a bit now when we had to take care of a liability or a payment issue on account for a taxpayer, it would take weeks sometimes to get a statement of account from the Department of Revenue. Sometimes our requests would be lost or they'd go to an incorrect address. Now, once the client gives me a one-time permission to be able to request statements of account on their behalf, I can log on to my personal eTides account and request a statement and get an updated statement the very next day. So it's pretty cool. A lot of practitioners love this, and it was just introduced at the end of 2016. Department of Revenue is hoping to soon add more capabilities to this feature, allow us to review outstanding assessments and collection notices as well. And then just an overall increased electronic communications with taxpayers. Anytime that they have emails on file, they're going to try to use that for taxpayers. I've already seen this for Board of Appeals. They're sending a lot of correspondence through email now, which used to be through mail. And if an email were to bounce back, they will send it out by regular mail, but that will be a focus of theirs going forward. I did see a question pop up. It's related to the CPE requirement. Someone asked, will the 4 hours of ethics CPE still be required for all CPAs with the law change? And the answer is yes. The only thing that's going to be dropped is the 16 hours of ANA. So the ethics portion will be continue to be in place. Quick update here on the Pennsylvania Tax Amnesty Program. I'm not sure if any of our listeners actually participated in, but maybe you had some of your clients participate in this program. It ran for 60 days back in April through part of June, and the main carrot here for taxpayers or delinquent taxpayers was the abatement of penalties and 50% of the interest, and also a limited look back of 5 years. If you received any of these notices for your clients, Pioneer was the facilitating agent, so they tended to be on the letterhead and listed as the main contact. The only major hiccup to this program was that there was a lot of notices that were sent out for old delinquencies. I saw some from the 80s and the early 90s. And when we called to address them, half the time the Department of Revenue actually had the return. It just was a glitch in their system that wasn't pulling it. So a lot of those notices, unfortunately, took some time to resolve. From a revenue standpoint, it was considered to be a success. It was estimated to raise $100 million. It ended up raising $114.5 million that was collected. Interesting fact here is that 21% of the taxpayers were from outside of Pennsylvania. So that's certainly was a goal to get as many of the taxpayers from outside Pennsylvania as possible to continue not only retroactively broaden the tax base, but prospectively broaden it as well. And then I just have a quick note there at the very bottom there. The Department of Labor and Industry for Pennsylvania is currently running an amnesty program through September 30th for unemployment compensation. All right, just some quick year in review items for Pennsylvania that I didn't think fell into any other specific category. Summer 2016, Department of Revenue reached an agreement back in July 1st of 16 with Airbnb to collect hotel occupancy tax for their clients. That's raised $1.5 million of tax just in this past year. Department of Revenue has actually reached agreements in the past for sales and tax purposes with other large online retailers such as Amazon, Vistaprint, and recently Wayfair. August 2016, these were both, you look at the two items there, were both passed with last year's budget and became effective in August. Sales tax vendor discount used to be a full 1% of the tax collected. It's now maxed out at $300 a year, hurt significantly medium-sized to large retailers. And then taxation of digital goods, which we talked about before. The fall 2016, this received some notoriety outside even the tax community. I think whenever Chris Christie's involved in something, it makes the news. But in September, he decided to pull the 40-year agreement for wage reciprocity that Pennsylvania and New Jersey had in place, which allowed Pennsylvania residents to work in New Jersey but only have Pennsylvania tax withheld, and then vice versa for New Jersey residents. Received a lot of backlash, and then in November, 2 months later, he said, okay, it's back on. It was going to be a revenue raiser for New Jersey because of New Jersey's higher tax rate, but not worth the administrative burden and the ill will from the political ill will. Spring 2017, the RC2 101, which is the C Corporation return, the due date for that was moved back to May 15th to be in compliance with or to correspond with the federal due date change that was moved back to April 15th. So this allows, again, still for 30 days beyond federal due date. Just recently, in June and July, the medical marijuana growers and dispensary permits were announced, and then the timbering exemption took effect July 2017. Again, that was part of Act 84, last year's budget. Kind of winding down here, I want to talk a little bit about some of the developments across the nation here as we look at the state tax landscape. So what are some things that are being considered in other states? Pennsylvania is definitely not the only state with a budget deficit at this point. In fact, I think California and Illinois would be quite jealous of our situation right now. But a lot of states are looking for new ways to just generate revenue. One that received a lot of notoriety last year was a direct contradiction to the Quill case of 1992, which established that the Supreme Court in that decision established that physical presence is required for states to be able to assess sales tax on vendors. That was 1992. That's a long time ago in terms of the internet was very much in its infancy at that time and did not have the retail platform, of course, that it does now. So a lot of states are losing money. There's been a lot of federal initiatives, Marketplace Fairness Act, to kind of try to streamline this, but states are getting impatient because nothing's passing federally. So Alabama, South Dakota, and then shortly after that, Tennessee and West Virginia decided to take things into their own hands. Alabama says we're going to instill or enact an economic sales tax nexus. So out-of-state sellers that don't have nexus in the state, if they still sell $250,000 to Alabama customers, they're going to have to collect tax, regardless if they have a physical presence or not. South Dakota was $100,000 or 200 separate transactions. Tennessee was $500,000, and West Virginia was $100,000 or 200 transactions. It'll be interesting to see what the higher courts are going to decide on this, but I think a lot of people are in agreement that something needs to be done, whether it's administrated by states individually or at the federal level. A lot of brick and mortar stores are losing out in a competitive nature because of some retailers online are not able or are not currently collecting tax. And if you leave it up to the purchaser, individuals, most purchasers and individuals are not going to remit use tax to the state. We talked about the use tax notice requirement for Pennsylvania earlier. 7 states have already enacted legislation. Colorado released some more details just earlier in this week about their program. So they're going to require a notice to be sent to the purchaser every time they purchase from the online retailer. But they're also going to have to accumulate a list at the end of the year of all the purchases for each customer and then send that customer an annual list telling them that they need to remit use tax. And then they're going to give those customer names to the Colorado Department of Revenue. So the Department of Revenue then can kind of tie out those lists and make sure that the customers are coming forward to remit use tax. Challenges to Public Law A6272, which states currently that income tax cannot be imposed on a business that's doing only sales activities in the state for tangible personal property. Ohio CAT's not quite an income tax return, but it's very similar. It's more of a gross receipts tax return, but that was a direct challenge to Public Law A6272. They said even if your only activity is sales activity in the state, you're not doing any other type of business activity. If you have $500,000 of sales, we're going to consider you have nexus and require you to file. It'll be interesting to see how some of the other states fall in line with that. We also have some retroactive legislation. Sometimes legislation is not popular for the business community, but it's much more unpopular when a state goes back many years and retroactively tries to apply that legislation. In Michigan's case, they made a decision to leave the multi-state tax compact in 2014 because and they made it retroactive to 2008 because they did not like a decision in an IBM case on state apportionment. So that's currently being challenged. Washington has done something similar for their B&O tax. And then there's a continued push among the states to go to a single sales factor instead of having sales, payroll, and property be considered into the apportionment factor. And then also market-based sourcing, both of which Pennsylvania has already enacted for C corporations, But as more states enact single sales factor, Pennsylvania businesses that have a lot of payroll and property in Pennsylvania are going to end up paying a little more tax in other states because they don't have the Pennsylvania payroll and property apportionment then to be able to weigh down or weight out the apportionment in other states, as it's just going to go off of where your sales are located. And then quickly, how does Pennsylvania compare? I just real highlight here, a brief. Tax Foundation releases an annual guide of how each state's business tax climate index is, and it goes off a number of factors depending on how complex the state's taxing structure is, what their rates are. Is a major tax not enacted in that state? Like, for instance, Florida doesn't have a personal income tax. Things like that. I am happy to announce that Pennsylvania improved from last year's rankings of 28th down to 24. And you can see the overall rankings there. The most of the taxes kind of held flat. Unemployment insurance tax rank and property tax ranks were improvements for Pennsylvania this year. This slide's kind of neat because it shows what Pennsylvania residents' tax burden for state and local tax purposes is as a percentage of their income. As you can see, Pennsylvania is pretty high there. It's number 15. So 10.2% of all income individuals earn in Pennsylvania essentially is being paid then towards taxes, various tax types, just for state and local purposes. You see California's number 6 there. It's actually not as bad as I thought, but as you can see, New York, number 1, that probably no surprise there, that has the highest tax burden. And then corporate tax rates, 9.9%. You can see Pennsylvania has the second highest rate there, but Iowa's tax rate is graduated from 6% to 12%. So Pennsylvania has the highest flat tax. Every dollar of taxable income is taxed at nearly 10%. And then lastly here, sales and use tax comparison. If you look at Pennsylvania, the average tax rate is 6.34%. Overall in the state, most of the state is 6%, but you do have Philadelphia County at 2% additionally, and then Allegheny County with an additional 1% tax, so averaging out to about 6.34. You can see that's on the lower half of sales and use tax rates across the country. So I'm going to turn it over to Tyler now. I know I have a couple questions here that he'll throw back to me, but I want to let Tyler have a chance to do some closing comments before that. First one is crystal ball. Will the budget impasse drag on like it did 2 years ago? Gosh, I certainly hope not. And I highlight that it will. That budget impasse went into February, I believe, of the following year. With the Senate voting today and passing their side of the revenue piece, and the House, I know it's going to conflict a little. They're pretty close. I think all sides agree, including the governor, that they're going to close the budget deficit. A major portion of that's going to be covered by the borrowing from the tobacco fund. I'm pretty optimistic that this will be resolved in August, but no one knows. Next question there, how does the CPA gain access to an e-tides to be able to get their clients' tax account statements? It's a good question. I have a nice little write-up from the Department of Revenue that shows with some screenshots of how to actually log on and get access to that. So I'll send that person who asked that question, I'll email them that. And if anyone else is curious, feel free to shoot me an email there. You see it on the screen, and I'll get that over to you. And then it looks like the last question here, we received a few Schedule C notices for our clients. These notices are asking for a ton of supporting information for certain expense items. Any tricks for handling these types of requests when we are getting such a high volume of them? We actually did talk to, earlier in the week, to the Department of Revenue, a couple agents there that are actually handling this program. There's so many notices being sent out right now. There's not going to be a lot of sufficient time for them to review it. I think the key thing is not to ignore these notices. There's a quick turnaround, often too quick of a turnaround, requested in the letter. I would supply as much information as you can that's readily available, usually a listing out of your QuickBooks or maybe an Excel listing of all your expenses. That seems to satisfy what they're looking for. I know some of the notices are requesting invoices as well. I wouldn't go that far unless they follow up with you. Because that could be pretty extensive, and I don't think even the Department of Revenue wants to see big wads of paper coming into their office. So the worst thing we do is would be to ignore that notice completely, respond, let them know you're working on it, and then send in listings of your expenses for the expenses that they're requesting some support for. And if they need more information, they will follow up. That looks like that's all in the queue right now. I appreciate everyone's time today, and that's going to conclude our presentation. Thanks again for joining me, and have a good rest of the night.
Thank you once again for joining us for this presentation produced by McConley and Asbury. We hope you join us for our upcoming events. You can stay up to date with news and learn more about our upcoming presentations by visiting us at www.macpas.com. Thanks again, and have a great day.